Who's Maggie? And how does she, or maybe actually it's an it, really, increases your taxes in ways that you just don't see? MAGI, of course, is not a person. It stands for Modified Adjusted Gross Income. And that's used deep in the dark recesses of the calculation of your tax return to actually increase the amount of taxes that you owe on a pretty regular basis. So we're going to talk about what this MAGI is, how it impacts you on your tax return, and some of the ways in which you might be able to minimize it, because you could be paying more taxes thanks to MAGI without actually realizing it. In addition, last week we talked a little bit about the notion of married filing joint versus married filing separately on the program. And so we're going to sort of tackle a little bit of a different twist on that. And that is the unfortunate and obviously emotional state that comes with the loss of a spouse and how that impacts your taxes. You may be surprised to find out that not only do you have to deal with the emotional loss of a spouse, but you also probably going to have to deal with a higher tax bill because now it's just one of you on that return versus two. Obviously, if we're unpacking all of these different tax issues, we always want to bring a tax expert into the conversation. So welcome to this week's edition of Dollars and Cents. Kristin, how are you this morning?
I'm doing good. How are you, Joel?
I am fantastic. We got a full show. For those of you who are not regular listeners to the program, you know that Kristin Cayley is not Kristin Cayley anymore. She is Kristin Castello. Did I say I got that right?
Mm-hmm. Yep.
So in the process of getting her name changed, thanks to a marriage that was what, a year ago, 2 years ago?
2 years ago.
2 years ago. Okay.
It's a long process.
It is a long process. I remember when my wife did that, and hopefully you complained a little bit, as my wife did, about having to go through the process.
Mm-hmm. Yeah, I made him go with me to the Social Security Administration office.
Wow. Wow. Now, that's a trip that everybody needs to only make one time in their life to the Social Security office, because once you go once, you'll never want to go again.
I never want to go again. I agree with that.
Well, very good. Kristin, of course, has literally an alphabet soup of accolades as well. She is not just a certified financial fiduciary, not just a certified financial planner, but also a CPA. So, given that we're going to talk about some tax stuff, thought it would be a good idea to have you on this week's program.
Yeah, thanks for having me, Joel.
Well, I know this was a little bit of a labor, if you will, because as our listening audience knows, we do tax preparation, actual tax prep work for clients of the firm at Nelson Financial Planning. And I know this is your super busy time. So thank you for joining me on the program this week.
Yeah, we are busy, but there is a light at the end of the tunnel. We're getting there.
All right. I like that. I like that. That is good stuff. Well, before we get into all of that, we want to kind of recap the week that was, because obviously it was a busy week. And the reality is, of course, that the Fed Reserve met this past week on Wednesday. That was sort of the big sort of major headline event, if you will. And what was interesting about the meeting, or I guess the conversation after it, because Jerome Powell, the head of the Federal Reserve, comes out and he gets interviewed by the media and they ask him a bunch of questions, things like that. And so they sort of reaffirmed that there would still be 3 rate cuts by the end of the year. And so that's obviously good news, right? Lower interest rates are always good for the ability of people to borrow. It lowers mortgage rates. Kristin, I know you got a mortgage recently here about a year or so ago. Maybe with some lower rates, opportunity to refinance, who knows?
Mm-hmm. Fingers crossed.
Fingers crossed indeed on that. And so the cost of borrowing obviously goes down, credit card rates go down, car loans go down, mortgage rates, all of that stuff goes down as the Federal Reserve changes rates, particularly if they're suggesting that there's going to be 3. Certainly the markets, particularly on Wednesday, really liked that conversation. Mm-hmm. Markets were basically kind of flat until about 2 o'clock. and then they had the conversation, and then, I think the Dow was up almost 400 points that day. So big move in the markets as a result of that. So obviously the markets applauded sort of that reassurance that there would be those up to 3 rate cuts. Of course, the big downside is for those that are sitting in cash, right?
Right. And there's billions of that.
There is billions of that. And we understand, we've certainly talked about it here on the program, talk about it at length with our clients in the office. It is a seasonal rate that is very attractive. That 5% or close to 5% that you're seeing on most money market rates. And again, make sure you're asking about what your rate is. We see this time and again, Kristin, in the office where people think they have a good rate and then all of a sudden they really don't.
Yeah, it's maybe 2 or 3%, and they're not getting that 5% that money markets are getting.
You gotta ask. Banks are not going to just give these higher interest rates away. You've got to ask. Maybe even get to the point where you say, hey, you know what? If you don't give me a higher level of interest, I'm going to take and find somebody else who will. In terms of trying to negotiate to get that lower interest rate. But as the Fed cuts rates, the downside is that if you're sitting in cash, then you're not going to earn as much as you were.
Right.
Certainly something to consider, and one of those things where if we think back through my history of doing this for 25 years now, there's been one other time where we've seen rates this high. It existed for a period of time, and then it disappeared. So just be aware of what it also is going to happen as the Fed cuts rates. But I guess allow me to express, some concern, or I guess I'm not convinced of the Federal Reserve's commentary on Wednesday, simply because I think the economic data continues to be decent enough, corporate profitability continues to be decent enough, that there isn't really any need to rush it. And then when you overlay the reality that is this year, yes, there is a presidential election, our view is probably that there might only be 1 or 2. I don't know that you get to 3. We'll see how all of that plays out, because obviously we do the show here, Dollars and Cents, every single week. So you get to see when we make comments about what we think might happen. We get you, the listener, get to see how we do over time. And I guess the other big news, right? March Madness.
Yeah, that's starting.
Can't forget
Crazy.
that. So here we are. The first round of games, is done. We're in the second round. And the neat thing is that, my bracket's already busted. I went with the whole easy 2-minute selection. We're doing a March Madness bracket challenge, I guess, at the office, right? So we wound up, I just wound up filling mine out quickly. Did you spend a lot of time on yours, or?
Not too much, but my husband gave me some insights, so I went that route.
Okay, very good. I think my insight is just pick the higher seed, probably do decently enough to stay in the contest for March Madness. We hope that your bracket is still in decent shape, but chances are it might not be, because that's the concept of March Madness. But certainly something fun at the office where we're kind of engaging in that and did all of our selections. Here's hoping that we stay. And what's the prize anyway? Did Jamie have a prize or no?
It's like a pencil
topper thing?
Topper, yeah. It's like a
okay.
little animal creature. They're cute.
We may have to step up that prize.
1 minute.
That seems a little on the light side when it comes to if you win the bracket at the office. So anyway, we hope that your bracket is not busted already. So anyway, well, we're going to shift gears and start to talk about some of the things that we talked about at the top of the hour. Modified adjusted gross income. MAGI, who is she? What does she do? What we can tell you is this, that she does have a dramatic impact on your tax return in ways that you don't see. So what we're going to do is we're going to talk a little bit about what that is. Make sure you know what it is, first of all. Talk about a little bit about what some of the impacts are with a modified adjusted gross income, and more importantly, how you might be able to reduce the impact of that, because it really does affect dozens of tax credits and taxation of different types of income for millions and millions of Americans. Coming up next here on Dollars and Cents with Joel Garris, Kristin Castello of Nelson Financial Planning. Talking about MAGI, Modified Adjusted Gross Income, and Kristin and I were talking during the break. I guess I'm not exactly saying that the way that you would normally say that if you were a true CPA, right?
I don't know if there's a right way. So I've always referred to it as MAGI, or the long word Modified Adjusted Gross Income.
Okay, well, MAGI just sounds a little bit more entertaining.
I like MAGI a little better.
Yeah, there you go. Whether it's right or wrong, the reality is that it has an impact on your taxes in ways that really are invisible to the millions of Americans that get impacted by this. I mean, this is one of those things, when you think about it, this notion of a modified adjusted gross income appears nowhere on the tax return. Mm-hmm. But it's lurking in the dark recesses of the calculation that determines how much tax you in fact pay.
Right. It's almost like a mystical calculation because it's different for everything that you're looking at. It's different for IRA contributions. It's different for your premium tax credit. It's different for Social Security. It's just different for everything. So it's almost like a mystical calculation in there. And
it's interesting. And depending upon which state, we'll give some specific examples here later in the segment. But depending upon what you're talking about, yeah, there's this thing that needs to get added in. There's the other thing that needs to get added in. It ultimately, at its core, right, it is altering the definition of income for tax purposes, right?
Right. So it starts at your AGI, which is your adjusted gross income, and that is on the tax return. It is line 11 on the 1040. Everybody has it, so you start there, and then you add certain things to it, or you can even subtract certain things from it.
And it certainly affects well over a dozen different tax rates used by millions of people. So when you start with that notion of adjusted gross income, that's on line 11 of the 1040. What happens next? Like what's the reality of why this exists in the first place?
Yeah, it's really to limit certain deductions for a lot of taxpayers. It's by limiting those deductions, it's more tax revenue for the people up in Washington.
Right. So in other words, a good way. The reason they mess around with this MAGI thing is that they can then reduce the tax savings or the tax benefits that come with certain deductions, and ultimately raise more tax revenue without having to say, "Oh, I raised taxes." Well, no, I didn't really raise taxes. I just kind of changed some definitions, which still resulted in increase in taxes. But anyway, so how do we figure out this modified adjusted gross income anyway?
Yep, so you start at your AGI, or your adjusted gross income, which is usually just your wages, your self-employment income, interest, dividends, capital gains, really all of your income summed up into that one AGI number. And then from there, you can take, usually you have to add back certain income items. So the most prevalent one that comes up is the tax-free income. So municipal bond interest is usually the first thing that gets added back. Sometimes other deductions, such as your student loan interest, will get added back.
Okay.
And then once you get that final number, depending on what the calculation actually is, that is your MAGI, or your modified adjusted gross income.
Well, it's so invisible, and this is where, the role of technology, the use of software really comes into play, because what you're talking about is, well, for certain calculations, I might add back in my tax-free muni income. For other calculations, I may add back in my student loan deduction. I mean, the amount of effort that it takes to calculate it, I guess, almost forces you to use a computer program.
And the most complicated one is actually the Social Security calculation. That is like a 10-step process. To do it by hand would probably take about an hour.
That is probably the one that we run into most of all, is that modified adjusted gross income as it relates to the taxation of your Social Security. Now, yes, to your point, there's schedules that obviously then exist that you can go and you can hand write out and hand calculate. But yeah, that in essence is where we see a lot of errors on individual tax returns that people prepare. As it all goes back to kind of how this calculation plays out.
Right, and a lot of times when we see them done by hand like that, usually the taxpayer ends up paying more than they're supposed to because they did the calculation wrong. So.
Yeah, in essence, the software industry in cahoots with the lawmakers in Washington, pretty good combination. Make sure you're using some kind of a software to be able to do that. So let's get into some of the specific examples that we've been talking a little bit about here. One of them, of course, is the ability to deduct your IRA. This is one that has a MAGI related calculation going on in the background.
So this one has an income limitation on it, and then it does have that MAGI limitation of you have to add back in your student loan interest deduction.
So if I'm looking at my tax return and trying to determine my eligibility to do an IRA deduction, then that modified adjusted gross income number that applies to determine that requires me to add back in the student loan interest.
Yeah.
So you got to remember that, because otherwise then that deduction winds up being limited. The next one is one that you mentioned earlier. Boy, this is one that really, every time we talk to people about it, it just kind of gets people wound up. What's this next one?
The Social Security and calculating that one. So it's one of the oldest uses of MAGI. So it's never been indexed for inflation, which is pretty incredible, because it's something like $25,000. If you're over that in your income, then it's taxable.
Right. And it's been around for at least 40 odd years, to your point, one of the oldest ones, and never indexed for inflation. So now more and more Americans find themselves picked up by that. Hey, great. Over the past 3 years has been roughly a 20% or so increase with the COLAs on Social Security, but that just means more folks are getting kind of picked up in this taxation of Social Security.
Yeah, and then this is one that requires your municipal bond interest or tax-free interest to be added back into the calculation. Which is unfortunate, because it's your tax-free income is now causing your Social Security to become more taxable.
Well, and this one really is a pretty convoluted calculation, because it's at zero, right? And it's not included, not taxable in Social Security. It's below certain levels, and then there's a sort of a phase or window of income where it's 50%, and then another level where it's 85%.
Right.
So that's not exactly something that you want to do by hand on it. And then I guess another one. These are ones that come up in the office on a regular basis that just people don't like. And so the other one on our list of examples is which one?
It's the IRMA, or the Medicare costs that come with your Social Security. It's income-based, so depending on what your income is for the year, your IRMA, your Medicare costs may go up.
Well, and this one, again, adds back in that tax-free muni bond income, and ultimately, this one can really bite, because if you're $1 over, I think there's 5 or maybe 6 different sort of income levels where the cost of your Medicare keeps going up. In some cases, if you're $1 over, not only you, but then it also applies to your spouse, you could easily be paying an extra $200 per month on your Medicare just by tripping $1 over the modified adjusted gross income limits.
Yep, and that'll last for the whole year until you file your next tax return and your income changes on that. So
pretty significant, real issue that people need to be aware of, particularly as they're working through their taxes. So what should the advice be, Kristin, for taxpayers to sort of deal with this? Because it's always out there, it's always lurking.
Just kind of understand that it's there, it exists.
1 minute.
And it kind of starts at that AGI, or adjusted gross income number, but there are some things that go into it besides that. So just know that it exists, know that there's a calculation, and use some tax software to calculate it.
Boy, I'll tell you, if you're trying to do it by hand, I don't know how you're going to ever do it. You've really got to use that tax software. And then lastly, you can certainly look for ways. There are certainly some ways to try and lower the reported income that makes up that adjusted gross income number. So what are some examples, that folks can use to help limit this?
Yeah, so if you're working, you can do pre-tax contributions to your 401k. If you're self-employed, you can do self-employed retirement plan contributions. You can do HSA contributions. That will also lower your modified adjusted gross income. And if you're retired, you can do qualified charitable distributions.
Oh, that's a great one, too.
Also help lower the
we love that qualified charitable distribution. Such a great way to use those RMDs to your benefit, have that not be taxable. So it also helps with the MAGI problem as well.
Right.
So that's cool. Well, good stuff indeed. Well, we're going to take a break here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. When we return, we're going to talk about some of the strategies to beat the survivor trap. Coming up next here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning. On this segment, we're going to talk about some of the strategies to beat the survivor trap. If you're a regular to the program, last week we talked a little bit about married filing jointly, married filing separate, sort of the option that you have as a married couple, and ultimately mentioned the notion of that the marriage tax penalty had effectively been eliminated a number of years ago. That was sort of a penalty that applied based on kind of the size of the tax brackets when you compared single versus married. That one got eliminated many years ago. But the reality is that the survivor trap has not. And this one sort of adds injury to insult, or insult to injury, I suppose, because you're dealing with the loss of a spouse. It's a highly emotional time. And then lo and behold, you wind up getting a much bigger tax bill as you shift from that joint return over to the single. So thought we would kind of talk a little bit about that and why it happens, how it happens, but more importantly, some of the strategies to minimize that. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida market. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel. Of course, any trouble finding our channel on your particular platform of choice, just go to our website, Nelson Financial Planning. There you'll see some icons. Click on those and they will get you immediately connected to those platforms, along with our YouTube channel as well, where you can see us in video doing the program each and every week. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Joining me on this week's episode, Kristin Castello. Welcome again to the program. Great to have you here.
Yes, thank you, Joel.
Kristin is certainly an expert of experts. She is not just a certified financial fiduciary, she is also a certified financial planner and also a CPA. So only appropriate that she be on the show this week as we sort of are in the thick of it, of tax season, if you will. And really appreciate you being on the show this week with us, because I know you're cranking through a bunch of tax returns right now. So
yeah, it's busy season, but we're almost through it.
All right, very good. I like the positive attitude. Yes, the days will go by whether we want them to or not. So anyway, so there you are, trying to navigate the harsh emotions, the tough emotions of losing your spouse, right? And then and wham, you get hit with that unexpected tax bill. So Kristin, just fundamentally, what's happening there? How does that happen? Why does somebody see that versus when they were filing a joint return?
Mm-hmm. Yeah. So you're going from filing that joint return to filing as a single individual. So what that's saying is you're roughly getting the same amount of income, kind of depending on your circumstances. So you go from filing a joint return for two people with that same income as a single person with that income. So the brackets do go up, the tax rates go up. It's just a different filing status.
Well, and it's a delayed catch, if you will, or it's a delayed trap, because in the first year, if your spouse lived at least a day in that year, then you still get to elect that joint status.
Right, yes.
So as long, but then it's like the next year. So it kind of like springs up sort of as you're trying to process through and get through the loss of a spouse.
Mm-hmm.
It doesn't hit the first year; it hits like the next year. So it's a delayed hit, if you will.
Mm-hmm. Yeah. When you're just trying to get back to a normal and the tax bill is much higher than you're used to.
Well, and so if the income stays roughly the same, just for our listing audience, what's the impact, right? I mean, so give us an example. Let's say 100,000. How does that kind of work? Like, what are we talking about here?
Yeah, so 100,000 for a married couple generally would incur about an $8,200 tax bill. So for a single filer, that same amount of income, 100,000, would be about 14,200.
Wow.
Which is a 73% increase. So it's a huge jump there.
Huge jump. Now, the reality is most of the time one spouse passes, there's usually some kind of a drop in income. But the reality is that there's still a pretty significant jump. I mean, a 73% jump in your potential tax bill. That is a tremendous amount. And so it's certainly important with that background to just have some strategies, know some strategies in terms of trying to minimize that tax bite and what it looks like. So what are kind of some of the things that people should be aware of and thinking about to try and minimize this survivor trap that pops up?
Mm-hmm. So the first thing that you should do is just kind of take a look at all your accounts and realize what kind of tax nature they have. So you may have some that are fully taxable, so pre-tax, you're looking at IRAs, 401ks, that sort of thing. Take a look to see if you have any Roth assets, which would be tax-free, and then also after-tax assets, which would be much like just your regular investment accounts. Kind of taking all of those into account, you can really start to lower your tax liability by strategically pulling out of those different accounts at different times.
Yeah, certainly to get past the survivor trap, what one strategy would be to take a little bit more out of the after-tax side, try and minimize the IRA side to the extent you can. I mean, obviously, if you've got a requirement of a distribution, then there you have to kind of employ other strategies like the qualified charitable distribution approach, those kinds of things. But it's certainly important. I guess really what that comes down to is knowing and understanding the difference and what assets you have, and most importantly, the tax nature of them.
Mm-hmm. Yep. And then on those investment accounts, you may get a step up in basis too, which would eliminate almost all of the capital gains on that if you withdrew it pretty immediately.
Yeah, another reason to use more on the after tax side to try and help manage the tax bill accordingly. So what else should folks be looking at in terms of trying to minimize this survivor tax trap?
So just take a look at your deductions and see what you're able to take. So the standard deduction does go down for married to single. It's almost cut in half, essentially. And then just try to look to see if you can itemize your deductions. Since you are getting a smaller or standard deduction as a single filer, you may be able to bunch up your deductions and itemize. So that would mean kind of looking at your medical expenses, keeping track of that, and then also your charity. So seeing if you can kind of bunch up the charity into 1 year and see if you can get over that standard deduction.
Yeah, and that's certainly something that I think a lot of people sort of forget to look at, particularly in these days where over 90% of people are taking the standard deduction. Reality is that, as a married couple for 2024, that standard deduction is like $29,000 and change. You go to a single person and it's like $14,000. So, but at $14,000, okay, wait a minute, maybe if you've got some medical, got some charity, things like that.
Right, and property taxes and all of those that before you wouldn't be able to get over the hump, but with the standard deduction being at $14,000, more likely. Yeah,
so certainly one of those things where you want to be thinking a little differently about that as well. And then another option is always to kind of look at whether there are any capital losses, particularly in those after-tax accounts. The rules on there are a little different. So let's recap those for our listeners.
So when you have capital losses, the most you can take on one tax return is $3,000, but you can offset all of your capital gains for the year with that. So the benefit does carry forward. So if you don't use it all in 1 year, you can keep carrying it forward and take at least the $3,000 loss every year.
Losses go
1
against
minute.
gains. Losses go against gains, but if there's extra losses, then you can use $3,000 against other income. Otherwise, the remaining amount just carries forward. And then, of course, spousal IRAs would another thing you need to be aware of on that.
Yeah, so if your spouse passes away, you can take his IRA as your own, or his or hers as your own, treat it as your own, and until you're 59 and a half, take regular distributions. Your other option is to treat it as a beneficiary IRA, and you could access it immediately without that early 10% withdrawal penalty.
Sure, makes sense. Anything else kind of on the things to think about?
Just be aware of your filing statuses that are available. So if your spouse passes away and you do have a dependent, you can qualify as a qualifying widower for the next 2 years and file as a married filing joint status with that dependent on the return.
You got to have that dependent on return. I think a lot of people think that they can do that, but you've got to have that dependent on return to qualify for that particular filing status. Well, we're going to take a break and continue the conversation here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning. So, Kristin, I got a question for you. How much time do you spend on Facebook? Do you spend a lot of time on Facebook, or not so much, or what's your Facebook appetite?
So I am a millennial, so I grew up with Facebook. So I used to spend a lot of time, but not so much now. But growing up on Facebook all the time.
Still, there's a tremendous amount of people out there, of course, who do use Facebook on a regular basis. One of the things about Facebook and why it is as profitable of a company as it is I think most people miss the fact that it's an advertising company at the end of the day.
Oh, yeah.
Most of their revenue will come from kind of the ads that you'll see out there on a regular basis. I know we as a company at Nelson Financial Planning certainly have run those ads. Those are the really good ones that you want to be paying particular attention to. Ignore everybody else's ads. Just ours are the only ones that are worth looking to at Facebook. But the other part is that you need to be careful about some of this stuff too.
Yeah, especially with AI, everything just seems so real, and there's all those promotions out there that if you click this link, you can lose this much weight and all that sort of stuff. It's crazy.
Significant, and it has a lot, of course, to do with your money as well, and especially when it comes to your money. So we're going to get into kind of the latest ads that are out there and why you need to be particularly careful with these ads. And we're going to give you some stats here later on in the segment that are going to surprise you as to just how much money is lost to some of these ads that are out there. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including whether some of the ads on Facebook are real or not real. My name, of course, is Joel Garris. Joining me on this week's episode is Kristin Cayley, or Kristin Castello. See, it's hard to remember, get that name change right post-wedding. And so we're here to talk about anything and everything as it relates to finances. Obviously, today it is, kind of middle of March or back half of March. I've been talking a lot about taxes. Kristin is not just a certified financial fiduciary, certified financial planner, but also a CPA rolling through tax season, if you will.
Yep.
Okay.
We're making it through.
We're
doing it.
I like it. And doing it without caffeine.
Yeah, first year without caffeine, it's going okay.
Wow. As I sit here and drink my coffee while I'm doing the show, good for you. That is good stuff indeed. So, these ads, we've been running them for years on Facebook, and let's face it, they are effective. We certainly have had folks that have become clients of the firm as a result of some of these ads that we've run on Facebook, although I have to admit, probably our most popular Facebook-related posting was our National Dog Biscuit Day posting, right?
I think it was the most popular.
Featured a lot of our furry friends. I think Walter got featured predominantly as well, right?
Mm-hmm. Yeah, I think he looked the best. He was smiling in his photo, so a little bit biased, but
I had to
think he
put
did the best.
peanut butter on our book, Next Gen Dollars and Cents, and put some peanut butter on the book in order for my dog to kind of like lick the book. And so it was a little bit of a staged ad, if you will. By the way, Next Gen Dollars and Cents available on Amazon at $14.99, or if you make an appointment for a free conversation at the office, Carolyn and Jamie usually pretty good about making sure that you get an absolutely free copy as well. So make sure you take advantage of that when you come in to see us. So what's happening on some of these ads is sort of the latest take, I guess, on an old-fashioned scam of separating people from their hard-earned money, unfortunately. According to the folks at FINRA, which is the Financial Industry sort of Regulatory Authority, sort of the oversight, if you will, of brokerage firms and the like, what they report is that they have seen a significant spike in investor complaints resulting from recommendations made by fraudulent investment groups promoting their returns through social media. And I guess the Federal Trade Commission also came out with some pretty disturbing stats that sort of quantify this.
Mm-hmm. It's something like almost $3 billion of lost money.
Wow. Yeah, I mean, that is a lot of money. And I think the other part of that stat is that the amount of money lost tripled from just in the past 3 or 4 years. So it is certainly a real issue that we see more and more investors, unfortunately, getting sort of caught up in. So what's the premise of these ads anyway? Like, how do they kind of attract your attention?
I've seen them too. I've seen them on Facebook. I've seen them on, Instagram, social media platforms. They catch you by saying, you just need to buy these 3 stocks, pay this entry fee, and I'll tell you what these 3 stocks are, and you can retire tomorrow. So they give these outrageous returns, something like 125% annualized or 25% per week, become a millionaire in days. It's pretty crazy.
Well, and the other layer, because as its face, right, you would hope that the average person would look at it and say, I don't think I can make 25% in a week. But they give the kicker of these ads, if you will, that makes them legitimate is that they usually feature some recognizable person of finance. Maybe it's Peter Lynch from Fidelity. I mean, there's some sort of quote unquote industry titan or expert that is sort of behind it, or at least it appears behind it to be behind it.
It looks like it's coming from their Facebook accounts, and
right.
they're putting out this ad.
Which the interesting story behind this is that the real people, okay, like the real Peter Lynch, the real Abby Cohen, they're at a loss at trying to stop these even.
Mm-hmm. It sounds like they've been trying to pretty aggressively stop these, but they just keep popping up, these new ads. It's hard for them to even get in front of it.
Well, and certainly using AI, regenerative technology. I mean, these ads certainly appear real, but at the end of the day, there really should be that alarm bell when someone is saying that you're going to get returns that are just so far out of the norm. That should really spark some alarm bells. But I mean, there's a mechanism for how the ad works. So how does it kind of start out in the first place?
So you click the link, obviously, and what they do is they try to get you into a WhatsApp chat room where you start talking about finances with you, and it's actually a group of people. So then what they do is they kind of scam you into buying a certain stock. You see the returns. You kind of test the waters with it. You put some money in it. You see some returns, and then they ask for more money. And then what they do is that whole pump and dump scheme. So they have you buy a penny stock. They have a bunch of people buy that same penny stock. They pump up the price, and then they sell it off, and they earn from it, and you're kind of left with nothing.
Very classic, age-old scam that has been around for forever, except it's just packaged a little differently these days. So if you click on one of these, you get into a WhatsApp group, and then you start to get these urgings to join a VIP room, or the moderator starts reaching out to you with personal questions and
1 minute.
sharing their personal information. That's a red flag. All of this is a red flag.
Yeah, and I think that the whole putting you in a team like that or in a group where you see other people earning and you don't want to miss out, or you see them all putting their money towards it and you don't want to be the one that lets them down, it's almost like a psychological tactic to keep you on board.
They are very good. Look, these folks that are scamming investors today, and by the way, these are investors of all ages. We see it probably even more so among younger folks than older folks. Just if it sounds too good to be true, it is. And just always remember that, and make sure you're not getting taken by these types of imposters and scams along the way. So, but with that, we will wrap it on up and get on out of here. Thanks for listening to this week's episode of Dollars and Cents. If you have any questions about the program or would like to discuss your personal situation, feel free to reach out to us at the office this week at 407-629-6477, or visit our website 24 hours a day, 7 days a week at nelsonfinancialplanning.com. Thanks for listening to this week's program of Dollars and Cents.